So, given what we've been through in the market the last couple of weeks, centered around the idea of short selling and predominantly short selling as an evil. And later on, I'll distinguish between covered shorts and naked shorts. And I think the anger was primarily around naked shorts. We'll see how we can get to a situation where you may be doing something that appears to be wrong without ever knowing that you're doing it. The thing that I'll focus on is short interest versus long positions. It is possible to have a short interest more than 100% of the available shares, but it is not possible to have short positions more than 100% of long positions. That simply can't happen, and I'll show you mathematically how that can't happen. But I thought I'd put out, a short defense against short selling, and probably, I don't think I'll be saying anything new that you don't already know. I may just be reminding you of arguments you may have forgotten because of the frenzy and that other argument being brought to the fore about the evils of short selling, and short sellers are evil. They're not. There's nothing wrong with short selling in itself. In fact, the absence of short selling would create many more problems and probably give us a market that is far less efficient than we have right now, and far less liquid that we have right now. So let's begin with some obvious statements. And for any level 3 candidate listening who has been through the level 3 content, I know that you're fully aware of the benefits of short selling as a useful tool for risk management, and that if we took that away, risk management would suddenly become very costly and very difficult, and that returns to investors. And when we talk about investors, let's put it in perspective. We're talking about endowments, foundations, pension funds, where the funds are going for beneficiaries for good purposes. It's not really just wealth concentration with a few what we call rich, greedy people. Number one, short selling is morally and ethically agnostic. If I owned a hammer, would you say that I was an unethical person for owning a hammer? That I was immoral for owning a hammer? It would make no sense. You'd have to explain that. Why is the person unethical for owning a hammer? Hammers can be used to construct things, to build houses. They can also be used to bash in skulls, right? And they have been used as murder weapons. Would we then say, because they've been used as murder weapons, all hammer owners are the same and all hammer owners have to go? I don't think so. That's a contrived example, but I think that we can separate the tool from the motivations of the person using the tool. Well, that's all short selling is. Short selling is just a tool. It is a useful tool, and an extremely useful tool and beneficial tool most of the time. And when it's not, you have to look at the user and not the use. It's not the use of short selling that's bad. Sometimes it is the user that is bad. And sometimes a user, through no fault of their own, could be doing something bad, but be absolutely unaware that they're doing it simply because of the nature of the system. And maybe that's where some work needs to be done. Number two, it preserves value and it generates income. So let's look at GameStop before all of the frenzy on GameStop, before all the attention on the short position came into be. If you wanted to short shares of this company, the lending rate was 30%. So if you bought into the fundamental argument, if you said, you know what, I've listened and I've read, and I think there's something there. I don't think it's an under $5 stock. I think it's a $15 stock. There's a 300% increase. I'll buy. And not only that, sure, I'll lend it out to the short sellers because the operations are going to prove them wrong anyways, and I'll get a 30% lending rate on the stock. You could have done that. If there was no short selling, I don't know that the price of the company would have been any different. Simply because it's the operations that would matter. The operations will eventually show up. Eventually the company has to trade on the fundamentals of its operations. Let's take Blockbuster, for example. If there were no short sellers at all, would we still be going down to Blockbuster to rent our movies? No, it would still be gone. It would still be gone. Let's talk about preserving value here. I've talked about generating income. If you think the short sellers are wrong, great. Find a target that short sellers are shorting. The borrowing rate will be very high, and if you believe they're wrong, say, I'll take your money, I'll take your lending rate, and I know you're wrong. Let's talk about preserving value. Let's use Blockbuster again. Let's assume that Blockbuster, and let's take Circuit City and Blockbuster. Let's go back to 2004, 2005, and let's each give them a market capitalization of $1 billion, and let's assume that there was no short selling or the possibility of short selling, which also means there are no derivatives. You can't have derivatives if you can't have short selling, because somewhere something has to be short to cover off those derivatives. So they're $1 billion long only. Would they still be around today in the absence of short selling? No, they would have disappeared anyways. They would have disappeared anyways, and $1 billion would have just shrunk down to zero. Now, if they had market caps of $1 billion, that means the stock times all the shares was worth $1 billion. There were $1 billion in long positions. That all would have disappeared. Now, assume on Blockbuster, $1 billion market cap, that you could have a 50% short interest. Well, what happens when that thing goes to zero? $1 billion is lost on the long side, but $500 million is preserved on the short side. It preserves value as opposed to just watching it all waste away. So let's go back to March of last year into April, when the market was just crashing. And that's what happens when there's this huge amount of uncertainty. It just keeps dropping. And you kept hearing stories of how many billions of dollars were wiped off the market that day. That's not entirely true, because some people were short. They were short particular names, or they were short the ETF, but they had short positions on the market, thereby preserving some of the value on the way down. Sure, the market caps may have bled off so many billions of dollars that day, but if you count all of the short positions, that much value was not lost. It's an overstatement to say that much value was lost, because shorting does preserve value at a society level, at a market level. So it preserves value, it generates income, it contributes to informational efficiency. Think of every major company scam or fraud that was out there. WorldCom, Enron, Wirecard. The majority of them were exposed by short sellers first. Now imagine if that didn't exist. How many more people would have bought Enron before they lost everything? How many more people would have bought into these companies that really were just made up numbers before they lost money? If we look at a couple of years back, I forget how long ago it was, but a bunch of Chinese companies were entering the US market by doing reverse mergers. But there was nothing behind these companies. And it took a short seller going over to China, going to each of these locations, saying, well, look at this. This is all this is. This company's supposed to be doing $15 billion, and it's just a one room on a second floor. And so he exposed all of this, so that allowed a lot of investors to avoid those particular companies. Well, imagine you didn't know any of that, or had no way of learning that, or no way of being exposed to that kind of information. How much more money would have been lost before the reality set in, because the fundamentals always show up in the end, and then all of that value is lost. So it contributes to informational efficiency. It allows you to buy securities closer to their fundamental value. So let's take a company or let's assume short selling is gone, which means derivatives are gone. You can only take long positions. You would be in the situation of seeing some companies trading for their scarcity value. Well, there's only so many shares, and this is what they're worth. And it would be divorced from their fundamental value. And you might argue, but that's good for people who are holding it long. But it's not good for people who want to get in. It wouldn't take long before the liquidity in the market would dry up, or would drop significantly, because I'm not about to buy something for its scarcity value. I want to buy it for its fundamental value. If there's no way to buy it for its fundamental value, I'll go somewhere else. So over a longer period of time, it would actually lead to lower prices and undervalued companies more often than not, simply because there'd be this unwillingness to step in unless you can get it at a discount, because you're not going to pay its scarcity price. So activist short sellers, to be clear what these are companies that will take a short position in a stock and then publish their research so that you can see it. That actually adds to informational efficiency. Is now we have a counter argument to the bull case, so that we can make up our own minds. We don't have to believe the short sellers, by the way. You don't have to believe them, much like you don't have to believe the long side either. It's just one source of information, and the short sellers are another source of information, but they do highlight things that we should pay attention to. And if they do cause some people to sell, well, it keeps that price closer to its fundamental value. Risk management. The derivatives market, by definition, has a 50% short interest all the time, because you can't have a long without a short. Would we ban that? The farmer who is looking at the price of soybean at $13.85 a bushel, saying, that's a good price, I don't want to take a chance, I'm going to sell forward my harvest at this price and lock it in, which means I can pay all my bills, I can pay any outstanding creditors, I can pay all my staff, even hire more. Maybe I can plant that back field that I wouldn't have planted at a lower price, but maybe now I can plant that field. Would we say that farmer is engaging in an evil practice by, in essence, short selling soybean? That's what you're doing. You're selling your crop forward. That's a form of short selling. No, I don't think we would say that at all. Same with an oil producer who wants to sell forward their production to ensure cash flow. The derivatives market really is a form of insurance. Now, take that all away. Even take insurance away. Think about it going all the way into the insurance market, because insurance is a form of protection on the downside. It's a form of a short position. An insurance company that sells you a policy on your house is basically long the value of your house against potential events that would destroy value, fire, flood, etc. And you're inherently short that. If we took away insurance altogether, let's say that you can buy any house you want, but it's illegal to own insurance on your house. There is no insurance market for the house. You have to accept the entire risk of purchase. If you think it through clearly enough, more and more people would be unwilling to pay higher and higher prices for housing. It would depress the value of housing simply because you had all the downside risk to yourself. You'd have to keep some safety reserve aside in case something went wrong. Everybody would have to keep some safety reserve aside. It would lead to less consumption in the marketplace because of those safety reserves. It would lead to depressed prices as well. Well, it doesn't take much to extrapolate that to a market. It would have an adverse effect on the valuation of companies if you couldn't engage in risk management. Short selling is a form of risk management, whether you do it at the index level, whether you do it at a company level. Let's take a good example of risk management at a company level, and I'll show you how this is not evil in one bit at all. I was a founder of a company, let's say, and I have 20 million shares. I have 10% or 15% of the available float, and I decide that I'm going to give my shares to a foundation on the condition that they never sell the shares. That's the condition under which my gift comes. They can never sell the shares because the shares pay a nice dividend, and there's your return, Mr. Foundation, but you can't sell the shares. The foundation accepts the shares, but it says, well, hold on a second, though. We have other stakeholders involved here, and this is a concentrated position that makes our portfolio, the rest of our portfolio, extremely risky. What we would like to do is to diversify away from this. Well, there are tools that they can use to diversify away. They can take the long position, and they can take an offsetting short position to lock in a risk-free rate. Once they do that, they can borrow against it to then invest in a diversified basket of stocks that may better serve the needs of their stakeholders. That's not evil. That's risk management. And that's called a short sale against the box. Nothing evil about that. It is a useful tool for that. So it is a form of insurance. Short selling is a form of insurance. And like any insurance market, it makes prices more robust. It makes valuation easier. It helps elevate prices as well, simply because you have that downside protection, and it adds liquidity. It preserves no arbitrage pricing. I said earlier that you can't have a derivatives market, an options market on a stock if you completely ban short selling, because you would have to find an offsetting person for each and every options position. So there are market makers who stand ready to buy and sell at the bid and the ask to add liquidity to an options market. Now, if the dealer can't short sell, they're going to widen that spread, and they're going to raise premiums on that and just pass it off as higher implied volatility, or claim that it's higher implied volatility. But you're going to pay a wide spread on that. Why? Because they can't hedge out their risk. If they take on positive delta in what they're doing, they have to hedge that out. If they take on negative delta, they have to hedge that out, which means depending on what side of the trade they're on, they have to buy a certain number of shares in proportion to the delta, or they have to sell a certain number of shares in proportion to the delta until they can find another counterparty to lay off that risk. So if orders come in for a buy a call, sell a call, great, they can match it up, off you go. But if an order comes in for buy a call and there's no liquidity there, they have to stand ready to fulfill that. That's their role in being a market maker, is they have to add that. Well, they got to hedge that out. If they can't hedge that out, the spreads become wider, which means if you want to engage in risk management, that you have a position and you say, I'm worried about the market dropping, this is a big position, maybe I'll buy some put. Oh, well, can't buy puts. You can't buy puts for any reasonable price because you can't short, and if you can't short, the market maker is certainly not going to do it for you at any price that makes sense for you to do, in which case you lose value. You can't even preserve value. So there we go. There's sort of a summary of the arguments that are out there. And these are not new arguments. They've been out there for a long time. I think it just helps to hear them again all in one place. It is a tool that can be, that is primarily used for good. 95, 96, 97% of all short selling is beneficial and good. Short sellers are actually positive for the market. Short selling research is actually positive for the market. Covered shorts are positive for the market. The big problem, I think, is naked shorts. That means you didn't arrange to borrow anything, you just went ahead and sold it. First of all, your broker shouldn't let you do that. If that's going on, that's a problem. That can be dealt with. But you could be naked and not even know it. Even your broker may not even know it until a week or 2 weeks later, or even 10, 20 days later, maybe never know that you were naked short. On the next screen, I'll show you how that works. Okay, I'm going to use a very contrived example. Let's take company ABC, and let's say it has a float of 1 million shares. That's a very, very tiny float, but let's say it has a float of 1 million shares, and they're all held long right now across a number of investors. And let's say that short sellers come along and they want to borrow those shares and they're going to short them. Well, to short them, that means they're borrowing the shares and then they're going to sell them. And when they sell them, that creates a long position for those who buy them, and you have a short position. So you have 1 million long over here, 1 million short over here, 1 million long over here. So you have 2 million long, 1 million short. In terms of short, the ratio of short positions over long positions, that's 50%. Meanwhile, the short interest, because there's only 1 million shares, short interest is 100%. The short interest is 100%, but the short positions are only 50%. This ratio over here can never exceed 100%. Now, let's go a step further. This is called a covered short, by the way. It's covered because they borrowed this existing million. So that is fully covered. What wouldn't be covered is if they borrowed 1 million, or sorry, they borrowed 1 million shares but sold 1,000,001 share. That one share would be naked. Can't do that. But now you have these long positions over here. Now, from this investor's perspective, they own the share. They don't know that it was borrowed and shorted and sold to them. From their perspective, they own the shares. They look at their account, they say, I got 10,000 shares, I own those shares. You know what? I'm willing to lend them out. So let's say they lend them out and somebody over here is short 1 million shares and they sell them. And you create another 1 million shares long. So now you have a million short here, a million short here. You're short 2 million, but you have 1, 2, 3 million long positions. Your ratio is 0.66 shorts to longs. Meanwhile, you have a 200% short interest. The people who borrowed these shares from this long side have no idea that they don't exist. Have no idea that they're actually over here. They have no idea. So in their perspective, they have a covered short. But somewhere along the line, we have a naked short position, naked shorts of up to 1 million shares. Meanwhile, these people over here who shorted the first million did all the right things. Made sure that they borrowed the shares, that they actually existed, sold short the shares, had enough margin in their account, whatever thesis they had for selling it. Not only that, they created the ability for 2 million shares long. As opposed to 1 million, they actually created more shares in the market to buy, thereby keeping the price of this stock closer to its fundamental value. Because if you wanted these million, you'd have to bid them up, and suddenly the price of the share reflects the scarcity of the shares and not the fundamental value. Now, these short sellers over here, from their perspective, did the right thing. They borrowed 1 million shares. They made sure they existed. They weren't naked. They were covered. In their minds, they have a covered short position, and they sold them in the market. They didn't do anything wrong. They didn't do anything wrong, but we end up with a situation where we have a problem. So you could have a system that creates a perverse outcome while everyone in the system does absolutely nothing wrong. And rather than looking at the position that hedge funds had on any particular stock and saying, oh, it's 120% of the float, it's 140% of the float, clearly something is wrong here. There may be nothing wrong with any individual in the channel, it's just something wrong with the accounting of all of the shares. So I think that if there's going to be some sort of regulation, which I think there should, I think you should not be able to get into a position where you have 200% of the float short. Now that's of the float. You still have a 66% or a 0.66 ratio of shorts to longs. There's still only 2 million short positions against 3 million long positions. Now the other side of that argument is this. If you're shorting a company that has such a high short interest, you deserve to lose money to begin with because you are entering a very dangerous situation. It doesn't take much for another fund to come along and say, I can squeeze those people. I can squeeze them. There's way too much going on here. I can squeeze them. And I think that's what happened and what we saw over the last couple of weeks, because other stocks that I was looking at started going up for no reason. There were a number of REITs that started going up for no reason. And then when you looked at their short interest before that, you found that some of them had 20 or 25% short interest. The shorts were just covering their position everywhere. Well, as those prices were going up, there had to be buyers. That means buyers were coming in at prices above the fundamental value, at elevated prices, only to watch them all come down again. So how many people, how many good people, thinking that there was value here, we're losing money all of a sudden. So trying to squeeze these short sellers en masse out of the market will actually create a more unstable market. And in the long run, if we limit it or try to get rid of it in any way, you'll end up with a worse functioning market with lower liquidity and less of an opportunity to get in. So that's my defense of short selling.